Grizzle Crypto and Bitcoin. Friends and family, SBF is in jail, and we are about to have a show for you. We got a show, man. We got a show. I'm Thomas George.
Margo Rubin.
Scott Willis.
We got a packed lineup. We are going to dissect this, the mayhem that was SBF, all that madness, and all that is crypto. What will come from the ashes? That's the question. Scott, hit him with this all-star lineup.
So we're kicking it off with the green chicken himself, Doomberg, and then we're going straight to Stéphane Ouellette. He's CEO of FRNT Financial. Then we got James Seyffart. He's head of Bloomberg Crypto. Then Ben Hunt from Epsilon Theory. This is going to be a good one. Lawrence Lepard, Equity Management Associates. And then we're ending it off with Greg Foss. He's the executive and shareholder of Valdez Power. So a stacked lineup. Don't go anywhere.
Woo! And without further ado, a good friend of the Grizzle. We're fortunate to have the Doomberg, the green chicken, back to back this week. If you don't know, Thursday is Uranium One-on-One. Doomberg can talk about anything, and he's here for you today for crypto and Bitcoin. Bring it up, Doomberg.
Hey, Team Crypto.
All right, Doomberg, welcome to the program. Crypto from the ashes. How's it going?
You know, Team Grizzle, always a fantastic experience, and I see you're growing. There's 50% more of you this time.
That's right. That's right. A recession for few, but you know what I mean? Not a Grizzle over here.
We're going to need a riser back there for the rest of the team.
Yeah.
Oh, man, a pleasure. Doomberg, listen, thank you for, I would say, our timing here is impeccable. Obviously, the green chicken can talk about most everything. We're very fortunate to have you here. And so obviously the state of today, obviously we got Bitcoin, broad cryptocurrencies. The market is rallying. So crypto is across the board rallying on the back of the rest of Sam Bankman-Fried. So the question is the market signaling that there's potential closure here? Doomberg, do you believe we're anywhere close to resolution on everything that has transpired over the last weeks?
I would say no. I would say we have a few more dominoes left to fall. I think Bitcoin and gold and the markets are moving on the better than expected CPI print this morning. If you ask me, not that I'm a trader and not that I'm that effective a student of the markets, but I think there's 3 or 4 outstanding issues that need to be resolved, I think, before you start thinking about a bottom being in. Look, the bottom might be in for the price of Bitcoin, but for the contagion that has transpired since the sort of crypto winter began, I think we still have a couple of more issues to resolve. I think there was a leak this week in Reuters about whether Binance would be charged for money laundering and various other potential offenses. And also, I think the whole tether question remains to be resolved. And of course, we recently wrote about GBTC and the discount to NAV. And so there's still a lot more open issues, I think, before you sort of have a true bottom, or at least a clear market. Doesn't mean that the price of Bitcoin hasn't bottomed, but I think the event and the headline risk is still quite high.
Absolutely. And the Binance situation today, that seems to be snowballing. It's interesting, while you're seeing cryptos rally, you're seeing a huge exodus of funds there on the Binance side. There's never a dull moment. I just wonder, stuff is still skittish, right?
Yeah, and I would correct you and say Bitcoin is rallying. The crypto word is a bit malplaced, I think, in that description. Bitcoin is rallying today.
Yeah.
But the altcoin world, I think, is terminally damaged as we know it. Crypto, Bitcoin, maybe ETH, but beyond that, I think we're going to see a full washout. And then the point of this whole discussion here is, rise from the ashes. What will rise from the ashes is a very interesting question, one that we've given a lot of thought to. But when the rise begins is, of course, impossible to time. But I would say Bitcoin is rallying today, but the world of crypto still has a lot of unanswered questions, and until we see a resolution to Binance Tether, the GPTC discount, I don't think that we're near the bottom of the headlines, like I just said.
Now, Doomberg, you made a good point about rise from the ashes. So maybe we're going to ask this to a few of our other guests, but I'd like to ask to you if you guys have been thinking about it. Like, do you think as we look through, whatever is the resolution here, and then we're back on the mend in the crypto world, in Bitcoin, is it what's gonna be left? Is it just the technology? Because I think it's hard to argue that there hasn't been some unique technology created during this crypto bull market, at least 2016 to today. Do you think certain projects can survive, or like, what is it going to be a total washout? What is your thoughts today?
So tomorrow we have our monthly Zoom call with our pro tier subscribers, and I'll give you a preview of what we've come up with. This is the end of year 2023 predictions, and so we've committed, or we will commit tomorrow to our pro tier members that we will for certain review all the ones we got right next year at the same time. But the big prediction for us in cryptos is not, it's an interesting one. I think there will be technologies that rise from the ashes, but unfortunately, they will be used to make central bank digital currencies a thing. And that's a trend that we think is just unstoppable. I think the world central banks are going to go in that direction, and they need technology to make that happen. And the surviving technologies that can be re-engineered to make central bank digital currencies a thing are the projects that you probably want to get behind in a sort of, assuming that you put your objections to such developments to the side and you're purely interested in a financial opportunity. I think CBDCs are coming, and I think the technology that makes that happen is going to be worth investing in. And part of the challenge with this crypto wipeout is, I believe, the blatant illegality and criminality that has been uncovered will be used to justify the development of central bank digital currencies. And so as long as that's going to happen and it's an axiom, then, as sort of an investor, I guess you have to think about, well, do I want to swim against that current, or do I want to just turn around and float down the river with it? CBDCs are coming. The technologies that enable it will be valuable. And if you can find an entity that is going to be participating in that, then at least you should try to make some money on the developments.
Yeah. Yeah. So now, just on the SBF side, just to turn on, I've got a couple questions, but we'll start with this one actually. Doomberg, we'd love to know. Obviously, you talk about central bank digital currencies, but your fundamental view. So obviously, there's the altcoins, shitcoins. A lot of different terminologies for them, and Bitcoin. To my knowledge, I've never seen you with laser eyes. Just your take. I'd love to get the real. Sure. Take on where Doomberg stands on the whole bit. Are you digital gold bug? Would love to hear it.
So I'm still a no coiner, so I've never owned any cryptocurrency, including Bitcoin. We do segment Bitcoin from the rest of the cryptocurrencies for a variety of reasons. We've gotten to know Lynn Alden quite well, and she makes a compelling case, and she's a good friend of ours. And we had her actually on our Pro Tier webinar a couple of months ago, and she did a great job of teaching our subscribers the difference between Bitcoin and crypto. There is a price. I'll say it this way: I would never own a crypto token, because I do actually agree with Michael Saylor on this point that effectively they're all unregistered securities. But there is a price at which I could be convinced to buy Bitcoin But so if you think about the people that are strongly behind Bitcoin, there's a lot of overlap in the Venn diagram between their thinking and the thinking of people who own a bit of gold as a hedge against the system. And I would count myself, and the Doomberg team would count themselves in that category. And so I'm sympathetic to the sort of moral arguments for Bitcoin. And there is a price at which I think, that we would, one of the things we're thinking about is maybe like accepting payment in Bitcoin and then just holding it for certain subscribers who want to pay in Bitcoin. And we would file our taxes, and the IRS has a known way to properly declare your Bitcoin holdings. And so we would follow the laws. The big question, and by the way, we're not talking about a significant part of our investment, but an allocation. Gold isn't a significant part of my personal net worth, but there's an allocation to it, both physical and paper. And I would put Bitcoin potentially in that category at the right price, not up here. And I joked with Lynn when I reached out to her one-on-one. I said, when Bitcoin gets to 1,000, I need you to teach me how to buy it. And she joked that might be that might be a sign that the bottom was in, because if I'm looking at Bitcoin 17,000 and trying to get ready to buy it at once, she thinks that might be, the bottom might be in, and she might be right. Like I'm a notoriously bad market timer. There is a price at which I would be interested to allocate some of my net worth to Bitcoin, and I would just buy it and hold it and forget it. Like I was very interested to see that Fidelity is getting into the space, and so I would put a very strong separation between crypto and Bitcoin, and there is a price at which I would be interested in Bitcoin. That's our belief.
Do you, I guess just a follow-on question to that I thought, it's interesting. Something so surprising to me is, just given all that's fallen out, is the fact that Bitcoin's been so strong here, right? And obviously, I'm not talking the, obviously alts. I think, share of you there, a lot of that stuff is gonna, go to zero. But I found it very curious and very interesting that Bitcoin's held in so well.
Well, this is why I wouldn't be a buyer today, because until we understand how GBTC resolves, because there's 640,000 Bitcoin involved in that structure. And until we see how Tether resolves, then I don't know that you can trust the price that you see on the screen. You could trust the story. You could believe in the concept. You can, and the other big question for us, of course, is can Bitcoin coexist with CBDCs? And I'm not so sure that they can. And so the U.S. could just, look, the U.S. has outlawed the legal ownership of gold in the past. There's no reason why they couldn't just pass a law that says owning Bitcoin is illegal. Doesn't do anything to the Bitcoin network, and it doesn't mean it, quote, destroys Bitcoin. But it sure affects the price of Bitcoin as measured in US dollars if they were to do that. There's a movement in Congress to make Bitcoin a security and not an asset. That would change things. So there's in a world where the central bankers want to implement central bank digital currencies, how Bitcoin is treated is an open question. But again, given my sympathy with the sort of foundational motivation for developing Bitcoin, and given the fact that currently it is IRS approved as an asset, the tax treatment is clear. You can buy and hold it, you could sell it, and you pay your taxes just like you would on buying and selling gold. To me, that separate from the cryptos, it's an interesting concept. And at the right price, I would allocate some and not worry if I lost it. And so that's really what I'm trying to say.
That makes a lot of sense. Now, I did want to get into your article last week. It was a really good one on Grayscale. You dug into the details of a lawsuit going on. So, Grayscale is the second largest holder of Bitcoin in the world behind Satoshi. I've seen some numbers on that. And then you look at post-FTX fallout, many are questioning if the Grayscale Bitcoin Trust does actually own the Bitcoins it says it does. And then you have Tether that's continuing to refuse to provide details about its collateral. Do you think, are there valid security concerns to why these companies don't want to give, full proof of collateral information to the market? Or is it potentially a smokescreen?
I would say up front that my base case is that they have the Bitcoin and there's some other reason that they don't want to disclose the information necessary to assuage the markets of its doubt. But in a post-Luna, post-FTX, post-Three Arrows Capital world, the market is fidgety. And any questions at all that can't be answered clearly, definitively, simply, and quickly are going to be the genesis of significant seeds of doubt. And so the fact that both Coinbase and Grayscale put this weird report out and tweet out basically saying for security reasons, we can't detail the assets. Well, in this environment, that was fine when Bitcoin was 60,000 and rising and everyone thought it was going to 1 million. It's not fine here where you've seen contagion, the likes of which is a hallmark of the global financial crisis of 0809, except there's no buyer of last resort and nobody knows where the contagion is going to stop. In that environment, you lose the benefit of the doubt. I still happen to think that Grayscale owns those 640,000 Bitcoins, to be very clear. And we made no accusations in that piece. It's just very odd and eyebrow raising in this environment of all environments where you want to be sharing as much as possible if you believe your book, that there's this weird security concern which nobody could really quite understand. And to put that in a report in a tweet is odd. And so that's why we wrote about it. So we shall see. I mean, again, that huge discount to NAV. So for example, one of the reasons why we wouldn't be interested in buying Bitcoin at 17,000 or 18,000 or whatever it's trading for is in that piece, we described how in the lawsuit, Fir Tree partners described that basically the redemption policy of GBTC is a choice, and they could choose to undo that. They're choosing to in the view of Fir Tree, they're choosing to stop redemptions so that they can charge more fees based on the value of the holdings, not the value of the stock. And if they decided to open redemptions tomorrow, there'd be an awful lot of fresh Bitcoin on the market, as people, sold it short and bought GBTC and redeemed to close the arbitrage. And so again, one of the milestones before we would be interested in opening a position, which for us involves a lot more friction than others because we have no idea what we're doing, and I would have to reach out to people like Lynn Alden to teach us how to do it, is the fact that this GBTC discount to NAV still persists. It's like 50%. It's crazy. And so there's an awful lot of supply that would come on the market, via futures and hedging and all the other ways in which arbitrage is typically closed, because you can also participate in the price of Bitcoin via the futures market. And so unless and until GBTC is resolved and Tether's resolved and Binance is resolved and Bitfinex is resolved, I don't know where the price of Bitcoin is going to go. It could go to 100,000 because, suddenly there's a rush to get Bitcoin because people are trying to get out of Tether no matter the price. So I have no idea where it's going.
Great point.
And so when I have no idea where something is going, which is most of the time, I don't participate.
So, as we're talking about resolutions, maybe we can talk about a little bit more details of the Fir Tree lawsuit that was in your letter. So as far as we look at, what are the moving parts and what are kind of the most important thing you're looking for to come from that lawsuit?
Yeah, so the Fir Tree lawsuit, I should give it a little background, it's called a books and records lawsuit, and Delaware, which is where the trust is incorporated, has very favorable shareholder rights, and one of the rights is to inspect the books and records of the company. And they have tried to get access to the books and records of Grayscale, and the company has refused, which is not totally unusual, and these lawsuits are pretty common. And corporations and trusts that are based out of Delaware will often say that these are just fishing expeditions for class shareholder lawsuits that are unworthy of the management's time. In this case, obviously, Fir Tree is a very sophisticated player, and we believe, and we said so in the piece, that they will get access to at least some of the books. Now, their primary motivation is to force the company to reverse its policy on redemptions so that the discount to net asset value is closed. I think in so doing, if there's some shenanigans going on, which again, my base case is there isn't, then Fir Tree would perhaps be in a better position to discover it, certainly than we are, for example. And as we reached out to Chancery Daily, which is a great Twitter account, these things tend to move pretty fast. The courts tend to be pretty favorably inclined to shareholder rights. And we suspect that in a matter of weeks or months, that Fir Tree will get access to at least some of Grayscale's books. And who knows what happens after that. But the whole point of the piece was to teach people about the Delaware courts, and which is something we have some familiarity with in our professional lives, and how that this lawsuit actually could be more important than you might think, and it could not. And so we try to be balanced in the piece. But yeah, that's what's going on right now with GBTC. There is a lawsuit with a well-funded plaintiff that is also coincidentally deeply short Tether, and publicly so. And so one wonders what the connections here are and what their hypothesis is for spending this money to work their way into GBTC's books. But that's what's ongoing in that lawsuit, and that's why we decided to write about it.
And so what will it take for customers to feel safe trusting crypto exchanges again, do you think?
Like for you guys, what would you need to see to put your money on a crypto exchange?
I wouldn't put my money on a crypto exchange, but if Fidelity was offering custody and I could buy it through my pre-existing Fidelity account, and I would basically be taking counterparty risk with Fidelity, a highly regulated U.S. institution with good reputation and all the protections that come with the regulatory architecture in the U.S. Look, people complain about regulators, but in reality, Jay Clayton was out with a comment this morning that I saw on Twitter, which was bang on, which is the U.S. has chosen to be very heavily regulated, and a benefit of that is customers don't fear what happened, with FTX happening here. Like, I don't worry about TD Ameritrade. Maybe you do. I don't. I don't worry about Fidelity. I don't worry about interactive brokers. These things are heavily regulated. There's insurance backing it, and I know people in the finance world and how much time and money they spend on compliance. and that comes at a penalty to them, but that accrues to the benefit of the consumer. And the crypto exchanges complaining about regulatory costs are basically just trying to not be regulated. And so I would never put my money in a non-regulated entity. But if Fidelity was the custody of the Bitcoin that they sold me, that would be fine by me. Because of the allocation, it would be a small percent of my total net worth anyway. And so in the world where Fidelity is not money good for the Bitcoin they say that they bought from me, I got bigger problems. That would be where I would do it. I would never do it on a crypto exchange, especially not one based in the Bahamas, and not one that has automated research on the wire instructions when I'm trying to send money to FTX. So,
Doomberg, one final question here. Just, Twitter's played clearly a critical role here in exposing a lot of the fraud, and it's just been incredible. Would love to get your thoughts on the future of journalism, and if there is a silver lining here, it's just to see what the power of a platform can be versus the classic institutions of the New York Times, et cetera, et cetera. Just what, as the number one finance Substack in the world, would love to get your take on the future here.
Yeah, and I should say definitively and clearly, we have played no part in exposing this fraud. We have played a part in describing others' work in exposing the fraud and giving them full credit. A couple of accounts that come to mind: Dirty Bubble Media and Bitfinex, and the sort of crypto skeptic crowd, like the Crypto Corner podcast, Crypto Skeptics Corner podcast, and so on. And those people have been early; they've been right, they have been loud, and they were largely ignored until now. They're all the rage, and good for them. Congratulations to them. They deserve all the credit. But I would say, to your question, the speed with which Twitter plus Substack works, the sort of citizen journalism, the trade-off is basically editorial sort of rigidity versus speed, right? And so in the citizen journalism world, you're going to get a potpourri of editorial quality, but as a consumer of such product, you get to know which people have done their homework and which ones haven't, and sometimes there's sensationalism and so on. But I think that's okay. Like, we don't need to be protected from people that maybe don't have the editorial control that Doomberg aspires to, or pick your favorite Substack. It's not professional reporting; it's citizen journalism, and that's why it has the adjective "citizen" in front of the word journalism. But the speed and the willingness to make big calls is leaving traditional media in the dust, in my view. And this is only accelerating a trend that was already ongoing, which is why, of course, we jumped into the Substack world 18 months ago, because we want to swim with the current. The hard lesson in life is always swim with the current. But I think this is a turning point in the sense that the traditional media was so wrong, with some exceptions. I would say the Financial Times has been outstanding in its coverage of the FTX scandal. But I think some of the real traditional media have beclowned themselves in the reporting of FTX, and are highly deserving of the ridicule that fell upon them for their initial responses to it. Now, since then, the New York Times has done a nice job, a couple of very good exposés. They're professionals. When they set about the task of doing their vocation, they tend to do it well. But the speed of the new media is something that the incumbent traditional journalism world is ill-prepared to respond to, and that's the literal definition of disruption.
Doomberg, as always, thank you so much. We're going to see you in a couple of days.
You bet. I got to go study uranium now.
Doomberg, thank you very much, as always, guys. And if you don't know, you clearly, Doomberg.substack.com. Doomberg's created the category, man. Finance in Substack. He's the number one Substack there. The Green Chicken's the number one Substack. Doomberg, thank you very much.
Thanks, guys. Good to see you.
Thank you.
All right, everyone, don't go anywhere. This is Grizzle Crypto from the Ashes. We're speaking with Steph Ouellette. He's the CEO of FRNT Financial. We'll be right back. All right, everyone. Welcome back to Grizzle's Crypto Conference from the Ashes. We're joined by the man, the myth, the legend, Stefan Ouellette. He's the CEO of FRNT Financial. How are you?
I'm doing very well, thanks. Watching,
Steph, how
watching
goes,
a
man?
lot,
I
watching a
still
lot of Congress today.
right. It's yeah, we're watching it a little bit. It would have been better if SBF was there, but man, what a crazy set of events, man. We picked a good day.
Yeah, no, definitely. And you probably got a couple of crypto people feeling a little bit better about themselves today too. So I think the vibes are improving for sure.
For sure. Scott, kick it.
All right, so Steph, we got to kick things off. Can you tell everyone briefly what FRNT does?
Yeah, absolutely. So FRNT is an institutional platform, and I really want to highlight that. It's an institutional platform. We don't deal with retail, and we typically deal with even investors beyond accredited in terms of the permitted clients and the ECP style designations. And we refer to ourselves as a capital markets and advisory platform. We have several trading business lines, which include structured products. We license technology to different OTC desks so they can conduct their operations, and we have a variety of kind of swap-like and lending products that we offer. And moving over to the advisory side, we have kind of a consultancy and general advisory. We do merchant banking-like services, and we have an asset management license that we aim to partner with clients and help them build their own crypto primarily and emerging kind of strategy portfolio. So we provide very kind of investment banking-like services to the nascent crypto financial services industry that is having some issues right now. But
so you guys are deeply embedded in the flows of money through the crypto landscape, it sounds like.
Yeah, absolutely.
Okay, got it.
And Steph, I'd be remiss to mention your newsletter, which is one of the top institutional newsletters. Those who don't know, it's a great read. Steph, you want to get so it's frnt.io/newsletter. If you're not signed up, sign up. It's free, and it's lots of great insights. We take a look at the chart of the day every day. It's good.
Yeah, no, it's that was typically a value add product that we had just for our institutional clients. It was very popular. I think we give a much more kind of level-headed voice in the space. A lot of the notes are highly, highly promotional. And, we've at FRNT, we've dedicated a good part of our lives to crypto. So we're obviously bullish, but there's definitely not always good things going on in crypto. And we like to call those things out. So I think it's a little bit of a different voice. Since we've gone public, which we trade in Toronto, we went public in April. We've made it a public-facing product so that retail investors can also follow along in terms of the narratives we're speaking to institutions about.
Cool. So what I wanted to get into is that you guys posted a press release kind of right after FTX happened that said you had no material exposure to FTX, to Luna, Celsius. There's been many large sophisticated investors that got tripped up in all of this and got their money caught up. Can you just talk to us about how you assess counterparty risk, aka blow up potential of a counterparty?
Yeah, that's a very interesting question. And the reason why it is that, there's very little commonality of kind of risk metrics that we would associate with each one of these blowups. In fact, we assessed each one of their blowup potential in completely different ways. And I'll give a little bit of detail in terms of what kind of led us to, avoid or de-risk to the as much extent as possible for these three particular blowups. I would say the only commonality amongst all three of the blowups is that our view at the time was highly counter consensus, and we had the courage of our convictions to stick with it, which I think is an extremely necessary part of surviving as a crypto company. Is that you can't get caught up in the noise. You really have to have courage in your convictions, and they have to be right. With what you decide to get into, or you leave yourself vulnerable to just as much blow up risk as the counterparties you're dealing with, of course. So in this case of Celsius, Celsius was very well known to be offering higher rates in terms of what they could offer to their clients from a yield perspective. Essentially, their primary business model was that you deposit your assets with them, crypto or fiat, and they'd give you a yield on them. And the question with any platform that does that is how do they get their yields? And it was well known, and Celsius was not kind of hiding at all that what they would do was take your yields and engage in kind of yield farming, DeFi, yield generating tactics primarily. And we felt as though a lot of those strategies were completely air, that were based off elevated token prices, and that yield farming was not going to be sustainable practice. So Celsius was effectively giving you a higher yield than everybody else, but it was only marginally so. They were actually earning a much higher yield than that with the risky strategies they were doing, and they were taking all the upside. So I'd say to somebody at Celsius, I'd say, like, hey, listen, like, why would I participate in these strategies with you when I feel as though, our organization and our partners could do as just a good job, and I get the upside, and I'm not even in these strategies to begin with. And honestly, the Celsius team wouldn't fight us very hard on it. They'd go, you know what, you're right, you're not exactly a fit for that. And that was that. With Luna, we have partners that are some of the largest tether market makers in the world that we invest with. And so, this is something we discussed with them when the Luna dynamic came around. It was a very fast growing stable coin. And we looked at whether or not this was something that we could potentially look at arbitrage opportunities in, potentially create products in arbitrage, et cetera. And I mean, it did not take us long to realize that the Luna Terra dynamic was unsustainable, particularly in the market sell-off. And that was really because basically they were trying to maintain a peg of a stable asset, which was US dollar, with a very unstable asset, which would be, the crypto you'd receive from the Luna Foundation, the Luna you'd receive after you bought a peg at a discount. Mm-hmm. And the issue with it was that, you buy a peg at a discount to earn as an arbitrageur a small spread, call it 50 basis points, you get a certain amount of Luna back. And Luna was so volatile that you had no idea where you were going to get out of your Luna. Maybe it could move 5%. For an arbitrageur, you think you're going to make 50% basis points in a trade, and you can run volatility risk of 5%. It's not a trade, right? But for those that were doing it initially as, they incentivized people to own Terra and Luna, the Luna was generally going up. So the initial arbitrageurs would buy the peg at, say, 99 cents on the dollar, and they would get a certain amount of Luna back. As Luna was generally trending higher, they'd probably sell their Luna at a positive, at a better spread than they anticipated. As it started selling off, they'd actually start to sell it at a worse spread than they anticipated, which disincentivizes them from supporting the peg, right? So we looked at, that was the extent of our conversation. It wasn't like we had multiple meetings on this. And we said, okay, well, it's a completely unsustainable dynamic, so we want to be as far away from this as we possibly can. And, it gets a little complicated when you don't know what counterparties are doing what in Luna, so you don't want kind of second derivative risk to them. But, so that was the assessment there. And, I think a lot of people could have made that assessment too, but there's just this FOMO that goes with these major crypto moves that people get sucked into. I mean, it's not a complicated insight, but we don't really have the FOMO gene here. FTX was a different story. I mean, FTX was by far the hardest blow up to avoid. We invest with market making funds where really they're trying to repatriate liquidity from exchange to exchange and try to manage spreads. And so, those funds would have been very much kind of in line of fire for people that would have had assets held on the exchange. But we thought FTX was a walking red flag. I mean, they basically didn't seem to us to take care of any of the hard parts of running a crypto business, which was, making sure you have the right regulatory elements in place. We have plenty of stories about how their accounting was obviously sloppy. They were growing so fast that they couldn't have the right security protocols in place. And for us, they were a walking red flag. Now, the kind of malfeasance that we've seen play out in the space was very hard to predict from an outsider's perspective, but nonetheless, they were a walking red flag. And it was clear that Sam couldn't raise the money in 2022 that he could raise in 2021. So I don't mean to give too much on that, but I wanted to outline just the kind of nuance that you need to understand to avoid these blowups, which are all different. I can't point to one number that is going to make you avoid all three of these blowups. You have to look at these things closely, have a view, and stick with the view.
And just on the SBF side of it, and obviously timely in all that's happening right now, just it just seems just the scale and all in to your point, something the pieces didn't fit right. I just maybe we can further delve into that in terms of how you guys look at that, the risk, and just like in terms of the systematic risk of such a large player like this. To me, that is just it's so profound that there was this sleeping nightmare in the industry, and I mean that's the part that I'm having a hard time reconciling. Is that how many other FTXs are there, and that if that you know what I'm trying to say.
Well, I would say that there's no organization that I have that I've observed the kind of red flags at FTX that I was, that we did. We have people that are close partners of ours in the Bahamas, and we had, just as a small island, people meet each other. They were giving people who had worked there for a couple months access to huge amounts of customer crypto assets, which is that, a lot of hacks are kind of internally driven. And so, that was really where we saw the risk on that front. And like, I mean, there was a lot that wasn't making sense to a lot of people. I mean, Elon Musk just expressed something that a lot of people were feeling about Sam's involvement of Twitter. You know, Sam was saying, "Oh, I want to invest in Twitter. You know, I have $3 billion to invest." So the story goes. And Elon goes, "Does Sam really have $3 billion? I mean, I'm seeing him spend all this money on, you know," and I'm paraphrasing, but you know, see, I spent all the money on sports stadiums. I'm hearing he's buying all these boats, like he's doing all this. There was a question of like, where's this money all coming from? FTX was undercutting fees left, right, and center in the industry. You know, there was this, you know, this relationship with Alameda that was, it was a little too like, you know, there's a lot of you know, I heard Doomberg on the last thing, and he's highlighting a lot of, you know, why would anyone send a wire to Alameda when it's supposed to hit on FTX? Well, the reality of the situation is that if you're dealing with offshore platforms that, you know, are operating under different regulatory regimes, that's not completely unusual. Right? And the way that trust has evolved in the crypto ecosystem is that, okay, there's some structural issues that crypto is trying to deal with, such as the fact that a lot of people can't get bank accounts, you know, with traditional financial players. So, okay, you know, they have a couple entities that have bank accounts, a couple that don't. It's not the most unusual story. And the way you build trust with these things over time is basically based on how they operate and the flags that you create for that, right? So when everyone starts to say, how does Sam have all this money for Super Bowl commercials? You know, how does he do this? How does he do that? The response, you know, that's the first right question. But the response then is like, I don't know, he's got so much money all over the place. Who knows? You know, it's Sam Bankman-Fried. So, you know, for people to avoid those blow-ups, they need to connect the uncertainty with the actual tough act of getting off the platform, which was not easy because it was the best platform in crypto in my opinion, from a trading perspective. Had some of the best, you know, risk systems, collateralization systems. The UI was really effective. So you had to leave all the liquidity on exchange for an opinion about SBF being a con artist that would have made the entire industry laugh at you, right? So it's hard to be that person in this space. And, you know, I was negative on DeFi all of 2021. And, you know, I became kind of an unpopular guy to have on podcasts and stuff because no one wanted to hear that. But I don't care. Like, I'm not trying to build a business I'm not trying to top tick our business's net worth here. I'm trying to build a 30-year business. So what do I care if, like, for 1 6-month cycle, you know, my opinion's unpopular if I really believe that it's the case? And so, you know, to the extent that we've managed to, and it's a spicy industry, look, like if Doomberg's right about a whole bunch of other, you know, platforms blowing up, you know, who knows what the cascading effects are everywhere, you know, even in the impact on the banking infrastructure that crypto companies rely on, who knows? Right. So, you know, it's not necessarily that we're out of the woods yet, but I definitely think that, our firm has shown that if you have a view that no one can convince you of otherwise, that no one's convincing you that, like, giving you a strong argument to change your opinion, why are you just going to go with the crowd? You know, like, unless someone can give you a factual opinion to change your mind, you're just going to roll over because everyone else is doing it. I mean, that's what happened across the industry, left, right, and center. And it's a very hard thing in the middle of this to have the courage of your convictions, but that's what you need to do to survive.
Now, Steph, I wanted to ask you a good question before we wrap up. So post the FTX collapse, have you either had to make any big changes in how you guys do business, or are you seeing any interesting changes now customers are using your platform or interacting with DeFi and other parts of crypto?
Yeah, so I mean, we don't really interact with DeFi, and I wouldn't say that we have really any DeFi products besides the fact that we offer products on, you know, liquid cryptocurrencies, some of which, you know, are decentralized, some of which are barely decentralized. And so, you know, but in terms of what we've seen, so, you know, we have a derivatives business here that we're very proud of. We have a very interesting structured products business that I think in future market cycles will give a lot of institutional access to the space in ways they haven't before. That core product of ours involved exchange counterparty risk. So there is exchange counterparty risk that clients were taking by buying those products. And right now, exchange counterparty risk is everyone's tip of their tongue. No one wants exchange counterparty risk. Now, I'll tell you, in 2021, no one was talking about exchange counterparty risk. So these things can change very quickly, right? So I'm not sure that those products aren't going to work in the future. Maybe we can find some creative solution. Maybe exchanges start to find ways to mitigate counterparty risk that we can get further comfortable with. But what we are seeing is an interest in doing derivatives where where counterparty risk is greatly reduced. There's some structures in which you can do that involve no counterparty risk to exchanges. They're a little less flexible. They're a little more vanilla. But so we've looked at adapting some of our products, or some of the products that some of the products that we're brokering trades into other products, or introducing clients to people who can do different kinds of trades, and we're getting a real influx of clients to us because a lot of our competitors just closed down the other day. I mean, I would say out of the people that firms I would consider competitors, I think 4 of them are out of business right now.
Wow.
And 4 to 6 or 7. So, and and I would say that we're one of the only firms that is still kind of taking those kind of calls right now. A couple of the other firms are basically doing like no client business right now whatsoever because they're just completely reassessing. And we feel like we have a very clear line in what works and what doesn't work in this industry, and we feel like as of right now, we're vindicated. We're never getting cocky, always staying cautious. There's always a new wolf in sheep's clothing waiting around the corner in this space, and there'll continue to be. So, we're pleased with our performance to date, but we're not sitting on our laurels.
Well, Steph, we always appreciate you stopping by and your willingness to talk to us because we know you see a lot of things. So it's always great to have a resource like you and FRNT to kind of ask what's going on and what is on your radar. So we definitely appreciate that.
And guys, if you haven't signed up, frnt.io/news newsletter, or you can also follow Steph on Twitter. He's always dropping great gems of insight. Steph, thank you so much.
Thanks for setting this up, guys. That was great.
Thank you, Steph.
Have a good one. Talk to you later.
All right, guys, don't go anywhere. Next, we have James Seyffart. He's head of ETFs, basically head of all crypto ETFs at Bloomberg. So don't go anywhere. All right, Grizzle Crypto Conference. We're back at it, and we're joined here by James Seyffart. He's ETF analyst at Bloomberg Intelligence. So we got a lot to talk about on Grayscale and other topics like that. So James, thanks for being here.
Thanks for having me. Happy to be here.
All right, so let's kick it off. I'm curious, you see a lot of things going on in crypto and the market in general. What have you been spending the most time watching and thinking about in crypto specifically lately?
Yeah, so to be like abundantly clear, like I tend to cover the asset management industry as a whole. And within that, within my team, I've been covering crypto for the past 4-ish years officially, longer on a personal basis than unofficially. So like anything that overlays that linking between the traditional finance world and the deep decentralized finance or crypto world is typically where I sit. So I cover a lot of Grayscale. I'm watching a lot of what's going on with DCG, Grayscale, Genesis, all of those above. But really GBTC is where my expertise sits, and crypto ETFs more broadly speaking.
Great. So let's segue into that. Can you give everyone listening an update on kind of Grayscale, Digital Currency Group situation, and what's the latest you're hearing? Like, do you think Grayscale Bitcoin Trust survives in its current form with what you know right now?
So there's a lot of information out there on Twitter and just in the broader space. I don't agree with all of it. The simple fact of the matter is we don't know enough about what's going on between Genesis and DCG. We know there's a lot of loans going back and forth between both of them. DCG is the parent of Genesis, and we don't know how bad the liquidity or solvency issues are having at Genesis and how much they'll affect DCG, and therefore what that impact will be on Grayscale and GBTC itself. Now, I don't think GBTC itself can survive in its current form much longer than in the next year or two. They need to figure out a way to open redemptions. There's a lot of questions around whether or not they can just offer redemptions right now, or whether or not they need some sort of exemptive release from the SEC, something known as a Regulation M exemption, which we can dive into a little bit further. More interestingly, Grayscale itself is suing the SEC under an APA lawsuit, basically saying they're being arbitrary and capricious. Those are very specific legal terms in the approval of Bitcoin futures ETFs and the denial of spot Bitcoin ETFs, which GBTC wants to convert to. So I'm watching that very closely. And I'm working with, I work in a team of analysts that cover a multitude of different things. We have litigations analysts who cover that area. Now, more recently, Fir Tree Capital, which is a hedge fund, just filed a lawsuit against Grayscale, basically trying to get them to release a bunch of internal information and other documents to make sure that they were fulfilling fiduciary duties and a whole host of other issues that they think might have happened. And Fir Tree is of the firm opinion that if they wanted to, they could operate a redemption program as it is without any exemption, which I'm not sure I completely agree with, but I'm not a lawyer, so I really, there's no way to know for certain on my end. I've talked to a few people, and it seems like a very gray area rather than a black and white issue.
So for people who don't know like the details of this, if I own Grayscale right now, just as a retail investor, could I just sell it? Could I just redeem my shares, or am I locked up?
So you can't redeem it, right? You can sell the shares in the open market, but what's going on right now, I'll actually look, I have a live, it's trading at a 48.8% discount to the underlying value of the Bitcoin. So say Bitcoin's trading at 20,000, you're basically buying it at like 10,000 and change, essentially. That's the way that the math would work out. So like if you wanted to sell, if you bought in at a premium or when it was closer to NAV, and now you're selling, like not only are you taking the 70% loss that Bitcoin has had over the past year, you're taking on additional losses because this thing is trading at a massive discount. The problem here is there's no way to fix those things. There's no way to really get at the underlying Bitcoin value. You're stuck with the share price of GBTC and no way to access the underlying value of the asset. And that's where all of this confusion comes from. And it's honestly, I would make the argument that Luna and Terra is the one that caused this, like these dominoes to fall. But one of the big dominoes that has allowed this to persist is the fact that there's no way to access that underlying GBTC. GBTC was used as collateral by 3AC. It was used in BlockFi loans. It was involved in many different areas. So if GBTC had the ability to access these underlying Bitcoin, we might not have seen the contagion grow as quickly or as staunchly as it did. So Grayscale and GBTC is at the center of everything we're talking about over the last few weeks.
Well, I wanted to ask you too, as an ETF research analyst at Bloomberg Intelligence, do you think the FTX fallout could have been avoided if the US had like a stable spot Bitcoin ETF? Because obviously that pushed people to choose riskier options.
I would say that's definitely, almost certainly the case for some small percentage of people. I mean, if I'm on, maybe for FTX US specifically too, because people knew that name was very well advertised, so people likely went there and there's no way to get access to spot Bitcoin, so like, I'll just open an FTX US account. But for the other parts of the exchanges, the offshore exchange, I mean, people on there, there's a lot of institutions, a lot of sophisticated people. There was people going on there to trade more than just buy Bitcoin, but anyone who sold like Bitcoin exposure, yeah, they would have been much better suited to buying a SEC regulated spot Bitcoin ETF. Now, obviously, you'd still be down 70, 80% or whatever it is, but you're not looking at a zero or a couple cents on the dollar, which it looks like might happen after bankruptcy if you're an FTX customer.
Yeah, so I had two more follow-up questions on Grayscale. So, in other parts of crypto, like stable coins, if investors really want to force the hand of the stable coin or some other asset, there's ways to put it in a lot of pressure and to say break the peg, for example. But it sounds like with Grayscale, it doesn't matter how much selling that goes on, right? The discount will just grow. So it doesn't actually force Grayscale's hand to do anything like redemptions. Is that correct?
Yeah, so there's two things to dive into here, right? So the one reason that everyone wants an ETF, including Grayscale, is it's just a more efficient vehicle. It's better for pretty much everyone involved. The downside for Grayscale is it would have outflows. So with an ETF, you have supply and demand, right? So whenever supply changes, demand, or whenever demand changes, they can change supply to meet demand. So if there's a lot of demand for it, they can create more shares, and it can happen basically instantaneously. Or if there's no demand, there's a lot of selling, they can destroy shares so that the NAV and the price always stays in line with each other. With GBTC, there's no way to do that. There's no way to destroy shares or unlock the underlying value like you would in ETF. So what happens, instead of outflows from GBTC, you just see massive discounts. So you see that discount, the value of the shares continually decrease compared to the value of the underlying Bitcoin that it's holding. So allowing for that conversion would solve the issue that we're talking about here.
And do you think GBTC has a good chance of getting converted into an ETF after all this happened, or no?
Or better or worse chance than before FTX?
So the way I look at it, I was on the record last year as thinking that I thought we were going to get a spot Bitcoin ETF in the second half of 2023. And part of that was because I thought there was this tail risk opportunity. Ironically, FTX was doing things that would have made their FTX US market regulated under CFTC, which would have satisfied the requirements that the SEC set out for approving a spot Bitcoin ETF. There's also, as many people will talk about, there was a lot of things going on in Congress, potential regulation, the SEC talking about doing different things that would allow for these exchanges to come under their purview voluntarily. And so I thought there was a tail risk that might even happen earlier than the second half of 2023. So like that tail risk, I think, is gone, or tailwind, if you will, because right now it's radioactive. Nobody wants to touch this. I think there's potential that we're going to see like a bunch of regulation come out of this. It might take a few months or years. I would never bet on Congress moving swiftly on anything, to be honest. But if it does happen, then that will be a benefit, because once there is regulation set up, or like an outline for people to follow, then all of a sudden it will satisfy a lot of the requirements the SEC is looking for. Honestly, so my case right now is outside of literal act of Congress. I don't think a spot Bitcoin ETF is happening anytime soon. So yeah, that answers the question on that front. But I think there is going to be regulation. So this thing could spur more regulation to come quickly. And if we get that regulation, then all of a sudden we get a spot Bitcoin ETF, even though it should be hampering a lot of things going on in the crypto space. It might actually aid in the approval of the spot Bitcoin ETF.
Okay. So just to help people who may be like, okay, what do I need to watch for to see what comes next in this saga? Do you think the digital currency group, who's the parent of Grayscale, right? They own a piece of Grayscale. Do we need to see a resolution with them, and whether they need to restructure or whether they go bankrupt before we then have a resolution on Grayscale?
So yes, I think the timeline for the Genesis and DCG to figure out what's going on there is shorter than the timeline we're going to see anything from courts in the Grayscale's lawsuit with the SEC, right? So that needs to be sorted out. I'm not an expert on that. I don't know exactly how that's going to be sorted out, but that needs to happen first. There's also the Fir Tree lawsuit, which I'm not sure when that's going to happen. We think that the Court of Appeals, like I talked to my litigation analyst literally earlier today, and they think second half of 2023 is when we could see an answer from the courts, possibly even earlier than that. But then there could be appeals, so who knows how long that could happen with the Grayscale lawsuit against the SEC. But this goes back to the whole issue of, I talked about those redemptions earlier, right? So part of the reason that DCG's in the trouble they're in, they issued a loan to 3 Hours Capital, a huge loan, many billions of dollars, and that's now been severely impaired. DCG basically took those assets that were impaired, the rights to go after whatever they get out of the 3AC lawsuit or bankruptcy. But what they got in return, what Genesis got in DCG, was they used GBTC as collateral. So this is actually hurting them on their balance sheet, because GBTC is not cash or dollars, which is what Genesis as a lending arm will use, and it's not crypto, which again is the other side of what they would use. So you're stuck with this asset that has significant value. They have 35 million shares that they just got in one fell swoop when 3AC defaulted. And now there's limits on how much they can sell. So basically GBTC is offered under Rule 144, and there's limits on how much an associated subsidiary or parent or whatever can sell. They can only sell 1% of the outstanding shares on every 3 months, right? So this thing, DCG, the parent company, all its subsidiaries own about 69 million shares of GBTC. So they can only sell they can basically only sell a small portion of that every 3 months. So even if they wanted to liquidate their holdings and help their liquidity sleeves, there's no way for them to do it in a quick fashion. So honestly, there's a lot of people saying they don't want to offer redemptions. I think if I'm DCG or Genesis, I want a way that I can actually offer redemptions without being in violation of Rule 144, which I don't think they can do. That's why I'm not so sure that, like Fir Tree's lawsuit said, they think they can just offer redemptions immediately. I think if that were the case, that DCG and Genesis would have figured out a way to do that, to access that underlying value, that underlying Bitcoin, because it would severely help their liquidity issues, like I said, because it's not crypto and it's not assets. It's this like middle hybrid that they can't really do anything with, and it just sits on their balance sheet. They can't even sell it.
Yeah, so if that were true, there's actually an argument that Fir Tree and DCG may be aligned in wanting to find a redemption mechanism, but that's not happening right now.
Correct. Yeah, Ryan Pincus of Masari often writes about how they need this Reg M exemption, which I think that would be the best case scenario for everyone involved, because they'd be able to access the underlying Bitcoin in some way because they could offer a redemption program. But Fir Tree thinks they don't even need that. I just don't know that I think the SEC would be willing to just grant a Regulation M exemption, which Regulation M is basically designed to prevent like manipulation. They don't want people creating shares and liquidating shares with fake values of the underlying, and you can just kind of basically make up what things are worth, which obviously isn't the case for Bitcoin. There's a full market for it. So it's designed to prevent that. But I just don't see the SEC, based on what we've seen from Gensler on the crypto space, what we've seen his comments about crypto ETFs and Bitcoin ETFs. Like, I don't just see them willy-nilly just giving a Reg M exemption. Like, some people seem to think, just apply for it and you'll get it. This will be better for investors. But it's been better for investors this whole time to have an ETF, and they haven't done it. So I don't know why anyone would think it's just going to be guaranteed that they're getting this Reg M exemption to create a redemption program for GBTC.
Yeah, it's never that easy.
I'm curious because before you talked about how GBTC is trading at over a 40% discount to its NAV. Overseas, did Spotcoin Bitcoin ETF stay relatively close to their net asset value during the FTX fallout? And how does the discount they experienced compare to GBTC?
So there was no discount. It traded completely in line. The spreads were tight. Basically, the ETF wrapper is extremely efficient. It's true. It's tried and tested, right? So like these things, the ones in Europe, the ones in Canada, even the futures ETFs we have here in the US, they traded tightly. Their volume spiked. The spreads did not go anywhere. They traded in line with the underlying value of the Bitcoin. There was no hiccups really whatsoever. So that just gives you strength to the actual ETF wrapper, but obviously hinders why the GBTC is not the most efficient vehicle. So you have people going to things like GBTC, you have them going to Michael Saylor's company, you have all these MicroStrategy, you have all these different areas of people trying to get access on the traditional financial rails that just isn't the most efficient vehicle to do it. So right now in the US, the most efficient vehicle, if you want it in your traditional financial rails, is the Bitcoin futures ETF, which obviously has its own issues, which we can dive into if you want to, but there's issues with that as well.
Yeah. So before we run out of time, I just wanted to ask your take on, what you've seen and what everyone's talking about as far as the contagion. Like, do you think it's run its course, or does it generally need some type of resolution? We haven't gotten the resolution. Is it somebody else has to fail, or we need to get proof of reserves, or like what's your feeling on whether we're through the worst of it?
I personally think there's going to be another. Yeah, it's a very loaded question. And like I said, I mainly sit in the TradFi side, but I tend to think that there's going to be more shoes to drop. I mean, you just know that like in some of these bankruptcies, a lot of the creditors don't want to be known, which is not normal. So that means there's obviously weaknesses there. There's been so much just interlinking of all these different parties that we didn't know about beforehand, right? So there's just a lot of things that's too opaque. Ironically, the crypto space was supposed to be completely transparent. You're supposed to see everything on a blockchain. And I feel like every couple of weeks, I just find out about this relationship that I'm like, that should not have happened. That should not be allowed. So I just don't see any stop to that. We're getting more and more information from John Ray. He testified in front of Congress today with the FTX situation. It just seems to keep getting worse and worse. So yeah, I'm not sure the contagion is over, and I wouldn't bet on it being over.
Well, James Seyffart, thanks so much for being on with us. And for anyone watching who wants to follow you and see what you're talking about, what's the best place to find you? I mean, obviously on Bloomberg, is Twitter a good spot to see what you're talking about?
Yeah, so outside the terminal, it's definitely going to be on Twitter. My team and I are very active covering the ETF space, and tangentially we end up covering a lot of crypto just because there's such a huge push from asset managers, even crypto companies, to get on the traditional financial rails to give access to crypto and Bitcoin. So I cover that space pretty closely, and I interact with a lot of people on there.
You can follow him at JSEYFF, in case anyone's wondering what his handle is.
Awesome. All right. Well, James, thanks so much for being with us.
Thank you very much. Happy to be here.
Everyone, don't go anywhere. We got a big guest next. It's Mr. Ben Hunt. You might know him as Epsilon Theory. He's been a thorn in the side of SBF, so we got a lot to talk about. Don't go anywhere. All right, welcome back to Grizzle. We're joined by Ben Hunt. You may know him as Epsilon Theory on Twitter, and he writes for Epsilon Theory. We're going to talk more about that. So welcome, Ben.
Great to be here. Thanks for having me.
Thank you, Ben. Ben, for those who don't know, you write Epsilon Theory is wonderful. I mean, let people know what Epsilon Theory is. I'm a subscriber, and just what the offering there, and the great insights that you provide on your website.
Well, thanks for that. No, I started writing Epsilon Theory 10 years ago, and it's just started as just an email I was sending some colleagues. I ran a decent-sized hedge fund for a long time, and just word of mouth, it just kept growing and growing. So started taking subscriptions for it a little over 4 years ago, and we've got about it's well over 100,000 readers now.
Wow!
So it's been it's been crazy.
Congrats.
Well, look, it's just a different way of looking at things. I think there's zero touting, right? I mean, there's never talk about any sort of specific investments. It's really talking about how to understand the world of markets and investing for sure, but also the world of politics, looking at through the lens of narrative. And not just looking at that, talking about narratives and kind of, wave your hands at it in a non-systematic way, but really talking about, well, how do we measure narratives? How do we understand how those narratives change, and how does that impact us as investors and as citizens?
Got it. Now, Ben, you've done some really great work on the FTX bankruptcy, so we'll get into that.
Thank you.
I maybe just wanted to start it off with a higher level on kind of what should we take away from the failures of these different crypto exchanges. Like, yes, it looks like there probably was fraud there, But was a bigger problem just there was a lot of incompetence and bad risk management? The people managing these companies maybe were younger. They didn't like. What do you think it was behind?
Not it. No, the fraud is the problem. Right? The fraud is the problem. And what I mean by that is that in so many respects, what we've seen through all of the crypto yield programs, the crypto exchanges and the like, this is old wine in a new bottle. The new bottle is the world of crypto. Right? But the scams, the frauds, it's old hat, guys. I mean, this is stuff that's been going on for decades, for centuries, really. I mean, it just follows all the classic patterns of just outright fraud. And what I take away from it is what you're seeing in the hearings today, and we'll be having lots more hearings, I promise you that. But the outcome of this is what always happens with financial innovation. And what happens is that the state comes in and papers it over. It always leads to more state power. Mm-hmm. And that's exactly what we're going to see here. Mm-hmm. And that it's frustrating to me because I'm such a big fan of, I'll call it I work with words for a living, but I don't have a much better phrase for it than the positive energy that I associate with crypto in general, with Bitcoin for sure. That by positive energy, I mean a spirit of entrepreneurialism. Mm-hmm. Yeah. I mean a spirit of personal autonomy. Yeah. And that energy, that effort, a long time horizon, all these things that I really appreciate. Mm-hmm. But because it's been applied to the world of money, because that attracts both the incumbent and newcomers to applications of fraud, the result of that is always that the government comes in and just kills everything. And it becomes an exercise then in more extension of state power, and that's what we're going to have. I like to refer to it. Bitcoin becomes Bitcoin with jazz hands. Bitcoin TM. No, I'm really serious. It's a representation of Bitcoin, but it's in partnership with Wall Street and government. It becomes something very different. It becomes co-opted. It's never banned. That never happens with financial innovation. Yeah. It's always absorbed and co-opted, and it's always absorbed and co-opted on the heels of con men and frauds like Bankman-Fried. Mm-hmm. This is the process. And I give you a dozen examples of how this goes forward. Or how this has happened in the past, and it's happening here once again.
And just on that, so it's an interesting the connection there of financial innovation is always met with almost a heavier hand, and in that construct, do you see an opportunity for Bitcoin? I mean, not just like to live in a world like gold. Maybe just I wanted to flesh out that part of.
Sure. No, I mean, gold's a great example. All right, because what happened with gold, and you saw it with the introduction of a gold ETF. What happened with gold is that the meaning of owning gold changed. It changed from whatever and why ever people wanted to own physical gold. It transformed it into a financial instrument, a security that could certainly be used by a lot more people, but the meaning of it changed to essentially an insurance policy against central bank error. That's the meaning of gold as a security today. Now, that was wonderful for all of the controllers of flow, which is Wall Street. Wall Street is a flow business. Right? It's not whether the price is up or down, right? It's what flows through, the money that flows through that Wall Street can take a small market making, piece out of. That's where the real money is. The real money is in flow, not in price. And a gold ETF was a wonderful thing for flow. But what it left behind were everyone who was owning gold, physical gold, for their own reasons. You became a gold bug. And I'll tell you, I'm sympathetic, frankly, because I'm an old white guy, right? Of course I'm sympathetic to gold bugs and talking about, oh, the world's going to hell and it's all going to be awful. You got to own your gold. I'm sympathetic to it, but I got to tell you, it's a miserable way to live. It's a miserable way to live.
Tom, he mentions that a lot. He just says it's not how I want to live my life, but he
That's
totally
right.
gets it.
Yeah. So Ben, in a past life, I managed the precious metals fund in Canada, so I've met my fair share of gold bugs. The problem is this, just the cup half full kind of, the world is ending. There's a classification that I enjoy, which there's a protection, just leave it and live a good life. But once you get into full gold bug territory, you almost just kind of go down this spiral.
Absolutely.
Which coming back to to your original words, which were really powerful, that idea of entrepreneurship and all that, that's almost the antithesis of a gold bug. Correct.
And my real concern here is that as Bitcoin becomes Bitcoin, trademarked, with full visibility of government into who owns it, and the notion of having your own wallet or any sort of autonomy, forget that. What are you, in favor of terrorism, right? You're either a criminal or a terrorist, right? And then what that does is that shunts the meaning of Bitcoin, OG Bitcoin, into that gold bug territory. And that's just so sad, but that's exactly what happens with financial innovation. You lose that positive energy, that sense of independence, of autonomy. It gets subverted and it gets crushed. And that makes me really sad, but that's where this is going, right? We have to live in the world as it is. This is where it's going. And so what's, I think, so critical is to find ways to express that autonomy, independence, entrepreneurialism, and the like without being crushed by these forces that are happening right now. And there's lots of blame to go around, and the first blame is on the Wall Street. I like to call them raccoons, right? And it's the fraudsters, it's the con men. They're the ones who ruin it for everyone. And here we go again.
Now, Ben, you've done such good work on FTX and put out some very thoughtful threads on Twitter. So I wanted to ask you about one of them. After you've been digging through these basically crazy lending arrangements between BlockFi, Voyager, FTX, Alameda, do you think the crypto lending market is basically a house of cards at this point, or what's going on?
Well, it's not at this point. It always was. And in so many respects, Alameda was kind of the supposedly the terra firma of this. Here's what I mean. With any sort of yield program, there has to be something that is actually making money, some real world activity that is actually making money to supply the yields that then trickle down, that intermediaries can capture a spread. Something has to be happening, right, to drive it, or the whole enterprise of, why is your crypto just sitting there? You should be getting some yield on it. Well, why should I be getting some yield on it? Right? Is staking some sort of real world activity that can accommodate tens of billions of dollars in yield product? Okay. But Alameda was this magical money machine, right? And so they were offering, give us your money, we'll guarantee you 15%, and you can call the loans back anytime. It was just a classic Ponzi scheme, and yet because we want to believe so much, and because there are so many, like I say, incumbent and newcomer fraudsters who see this as fantastic, right? I'll play along. I'll ride this wave of the Alameda Ponzi, to create my own, yield program. I'll ride this wave as long as I can. If we can fake it till we make it, what's wrong with that, right? So it's not that this has become a house of cards, is that there was no there from the outset. And what really makes me angry, guys, I got to tell you, is that when these sort of programs are marketed to the big boys, fine. If you don't see what's going on, more power,
Yeah.
your own problem. What really bothers me, though, about all these is how they're marketed to, I don't mean this pejoratively, retail, to just ordinary people. They've got some money squirreled away. They've got some money. They want to try this, and they think that they're a depositor in something like BlockFi. BlockFi had no depositors. They had unsecured creditors. Right? BlockFi, they paid a $100 million fine because they used the language of banking and safety when there was nothing banking and safe about it. So that's what really gets me, right? And that's why I get angry when I write and when I do my tweets. In this real effort to try to uncover, frankly, the truth, so that you can make up your own damn mind about whether you want to participate or not. That's it.
And I guess, Ben, just you're thinking out loud here on jazz hands, Bitcoin, and I like that term a lot. Is there from this? Do you see any silver lining that that we come away with something out of crypto that is functional and enhances, like as you put it, you can't create yield where there is none. There's that whole like world of magic money that just goes away. But I'm just kind of curious, where you see this, if there's anything we can pull out of this, obviously outside of Bitcoin.
Look, there's got to be, from my view, from my perspective, an attempt to kind of recapture the OG ideals of Bitcoin. That only happens if you crush number go up. I mean, just crush it. You crush the Michael Saylors and the MicroStrategies of the world. I mean, don't get me started on Saylor and his fraud from the .com era. I mean, people don't change their stripes, and that's very true for the people who get the Wall Street crowd that wants to convince you that it's a number go up story and that you should buy their version, their wrapper, whatever that is, that turns Bitcoin into Bitcoin. I think all of that's got to be crushed. I don't think it will be crushed because government comes in. There's too much money to be made from Bitcoin. So if there's money to be made, government and Wall Street will make the money. So I'm not terribly optimistic, frankly. I would love to see this energy and entrepreneurialism and autonomy of mind applied outside of the world of money. But unless that gets obliterated, then I think you've got a reservoir population, as they would say in the study of viruses and diseases, right? And so far as long as you've got that virus, that reserve population, reservoir population of raccoons and fraudsters, it's hard for me to see a lot of positivity that comes out of this.
Well, and the other side of that, Ben, too, is you got a reservoir population of degenerate gamblers that this all created.
Yeah, sure, and I speak as one, right? I mean, I get it. Honestly, I get it, and I'm not opposed to a casino, and frankly, a regulated casino.
Mm-hmm.
But what I'm, as a human being, much more interested in is life outside the casino. And it's so long as the casino is where all the attention is placed and where all the neon signs are pointing, it's very hard to get attention to be paid outside of the casino, even though as a human being, that's where I think it's so much more important.
Wow. Well, Ben, I think we got to end on that note, but thank you so much for your thoughts and for coming on Grizzle Crypto.
My pleasure. Thanks, guys.
Ben, thank you so much.
All right, everyone, don't go anywhere. The guests keep rolling. Next, we're going to talk to Lawrence Lepard of Equity Management Associates, so don't go anywhere. righty, everyone. Welcome back to Grizzle Crypto from the Ashes. You know, we got to thank our sponsors, otherwise this wouldn't be possible. So, Tom.
Yeah, well, wonderful partners. Real partners, extended partners.
Yeah, more than sponsors.
Yeah, well, it's these guys are the guys who all came together. Really, it's all our guests. But a special thank you out to Doomberg. He been with us since really the Grizzle conference series began. Can't thank the team over there enough. Their quality and thought on all topics related to finance. The number one finance Substack in the world. Doomberg.substack.com. Epsilon Theory. You just heard from the man, Ben Hunt. That was a deep discussion. If you want,
there was
more
heart in that discussion.
Yeah. That was a very beautiful discussion there. Epsilon Theory is a website community, examines social worlds of politics and investing through a lens of narrative. Go check out Epsilon Theory. And finally, we just launched Grizzle Research and Quant. That is Grizzle's contribution to Substack. A little different take. We research companies. We're stock pickers, but we also are providing a take on analysis through the quantitative lens and portfolio construction, something we feel is missing in the dialogue of investing. And I think it's something important that all investors should consider. That's our take here.
Where do we find that?
That's at grizzleresearch.substack.com.
All right, and now we're excited to have Lawrence Lepard. He's a lead manager at Equity Management Associates. Lawrence, welcome. All right, we're joined by Lawrence Lepard, Equity Management Associates. How are you?
I'm great, thanks. Appreciate you having me on your show.
Thank you very much.
So, Lawrence, I want to just kick things off with Bitcoin. Has anything about Bitcoin's behavior in the last 2 years compared to, say, maybe the 5 years before that, has it changed your opinion on how Bitcoin should fit into a portfolio over a whole market cycle, not, over a year or something like that, i.e., it's been heavily correlated to NASDAQ lately. Does that worry you?
Yeah, that's a great question. So I bought my first Bitcoin in 2013, and I bought a lot in 2017, and then I rode through the bear market following that. So this isn't my first time of watching this thing go, up a ton and then come back down a ton. Back then it wasn't as correlated with the NASDAQ. It wasn't widely known or traded. But, look, there's certain elements of Bitcoin that attract a quote unquote risk on crowd, and, just kind of the whole number go up crowd, and, they chase price performance, and those people rent it, right? They rent it, they buy it because they think it's going up, and they've listened to Plan B, or they've whatever. They're people who pump the hell out of it, and so they chase it the same way that people chase Tesla and they chased other, meme stocks and so forth. That's not who I am, and that's not, why what I consider to be long-term hodlers buy it. Long-term hodlers buy it because it's a new technology. It's fundamentally different. It represents something that the world never had before. It's, quote unquote, digital scarcity. And that's a technical innovation, very much in the way, I encourage people to think of it as like, before we had the printing press, you couldn't multiply the printed word. You had to have monks copying the Bible one at a time, or copying stories or whatever, writing them down one at a time. And the printing press came along, changed the whole game. And so, this is a similar kind of technical innovation. There was no digital scarcity in the world until Bitcoin arrived. And Bitcoin arrived, it brought digital scarcity. And that's an enormous development. And it's a very important development. And, it's been adopted over the 14 years it's been in existence. But in true form, we're really still in very, very early days. We're just starting to reach that tipping point where it's gotten out so that most everybody's now heard of it. In 2013, no one had heard of it. 2017, very few people have heard of it. And now pretty much everybody's heard of it, which is not to say everybody's bought it, because probably the number of people who bought it is still less than 10% of the United States, and certainly less than that if you consider the entire world. But, so it, does it correlate with the NASDAQ at times? Yeah, it did, because it was a risk on trade. But, I think over a longer period of time, it's going to, become a risk off trade. I know that's hard for people to believe given the price volatility that we've seen, but it does represent a form of money or a proxy for money that can't be printed by the government. And I would actually argue that, printed money is the real risk-on trade.
Yeah. Lawrence, just on that point, and this is something I've thought about it, is the fact that we're just so early right now in Bitcoin, and that's where a lot of the volatility is being expressed. And I just, I think back to how volatile was gold during Jesus, baby Jesus, or so. You know what I mean? Something
right. We don't know, right? There's no data, but
I don't know how what the price would be. I got to get something for Jesus. He's morning. You know what I mean? Wait, how volatile is the pricing day to day? But the question is that obviously Bitcoin was born in the era of social media, and almost in at that point of you have just so much of the for lack of a better term, the pump. And I just don't know how that goes. I struggle thinking about how that dynamic of people just getting excited, then giving it the correlation to NASDAQ and risk assets. It's just going to be more money that flows in there and just kind of gives it the anchor. I'm just trying to think about that out loud, if you will.
Yeah. Look, I don't know the answer. None of us know. It's a wild beast. It's hard to predict. I often say the volatility is because we're trying to put the ocean into a swimming pool, and we've got to expand the swimming pool until the ocean gets in there. And another thing that drove the volatility this past cycle that I think far too few people focus on was that in an era of free money and a lot of other cryptos out there around it as well, there's just a lot of leverage being used. And, we all know leverage can lead to volatility. A leverage allows you to play much bigger than your equity would suggest. And so it can really drive price swings. Wherever there's leverage, you can get crazy price swings and you can get bubbles. 2008 was leverage in real estate, and look at the bubble we created there. The dot-com bubble, had some leverage involved. So, and what happens is you get, we're all hardwired to herd to a certain degree, right? We see, because that was a survival mechanism, oh, danger, let's run this way. Oh shit, they must know something. I'm going to run that way too. Right. So we all herd together until somebody realizes, hey, there is no danger here. Let's stop going that direction. And that's, we tend to herd into investments. So number go up, tends to attract more number go up until it doesn't. Until people realize, hey, we're way too far out over our skis here. The value is not there yet. The real buyers aren't there yet. The marginal buyer disappears, and then the price comes crashing back down to earth. It's going to take time for this thing to be more fully distributed, for more people to understand what it really is. I have seen studies that show that as volatile as it is today, the volatility is decreasing with time, which is what you would expect. Right? You would expect that as you get more and more. Look, gold is volatile to a degree. The gold price goes up and down. Not the way Bitcoin does, obviously, but it's gone up and down over.
Well, Larry, the problem with gold, it just doesn't go up.
Well, yeah, you've been looking at the last few years for sure. That's the truth. It does if you consider that, in 1971 it was at $35 and now it's at 17. So, it depends on what lens you're using, right? What time frame you're looking at. Over longer time frames, gold has gone up, and it's been shown to hold its purchasing power. The whole story of a 1 ounce coin would buy a toga in Roman times. It'll buy a men's suit today. So, there is a certain amount of stability to it on a longer time frame. But yes, in the short run, it's volatile too. But
well, Larry, on that point, and just I kid, right? Obviously, our partner Chris Wood, he's previously still has he just says, listen, for a Japanese citizen, it's been quite good over the last year, right? Gold,
gold is making new highs in several currencies. Particularly, Turkey. Boy, you really, and the story was in Turkey, all the old people were buying gold, and all the young people were buying crypto, right?
Well, that's the point. I wanted to talk to you about that, in terms of stratification here and how you think about it. Do you own, is gold a part of your overall mix? And maybe just compare and contrast. Is this generational split where, from an asset allocation perspective?
Yeah, let me talk about that because
yes, please.
So I manage a fund, and the fund's goal is to protect you from monetary debasement, which I believe is kind of a mathematical and cultural certainty. I suppose if governments suddenly got responsible and spent within their means, I could be proven wrong, but we all kind of laugh when we hear that concept. So, I manage a sound money fund, and the bulk of the money in that fund is in gold and silver related items. Okay. And the reason for that is that, professional investors or people who give me their money to me to invest, they don't want to have 70% drawdowns. They don't care if it can go up 10x. A 70% drawdown just scares the living shit out of them. So, my fund might be, call it 85% gold and silver related things and 15% Bitcoin related things. So I still got some upside from the Bitcoin, but not as much. I mean, just so people would know, personally, I'm about 50% in my fund and about 50% in Bitcoin. I think Bitcoin is the fastest horse in the monetary debasement race. I think it's going to do much better, but over a long time, it's already crushed gold in its brief life. I think it'll continue to do that, and eventually it'll demonetize gold. But in the short run, that's going to take years. And in the short run, there are two things to consider with an asset: how much can it go up, and then what's the standard drawdown. So if you're 70 or 80 years old and you got $10 million and you put it all in Bitcoin, you have an 80% drawdown, so your 10 million becomes 2. And you've got you're 80 years old, so you've got maybe a 10-year time window or something. That's pretty shitty and pretty scary. You can't handle that drawdown. If you're 30 years old and you put all your money in Bitcoin and has a drawdown, it's going to recover and go into higher numbers. You don't care, right? And so there's kind of a time preference based on age. And the largest annual gold drawdown that I can recall seeing is close to 30%. And it's very rare. Most years it goes up, or the years it's down a small amount. Whereas, as we all know, in the Bitcoin case, there have been multiple 70% drawdowns, multiple. So, when you enter an asset, you got to ask yourself, am I willing to endure that drawdown to get to the promised land of, $200,000 Bitcoin or $1 million Bitcoin, which I believe we will reach. I'm not sure exactly the time frame. Nobody can be. But if you want to have sound money, and the way I portray these two things, I call gold analog sound money. I call Bitcoin digital sound money.
I love that.
Right?
That's great.
That's great.
Right. And it's kind of correct. Right. And, and so, and I think that everybody should own both. And if I were 30, I'd probably own 100% Bitcoin. And if you're 90, you probably want to own 90% gold and 10% Bitcoin. I mean, I think everybody should balance these two sound money bets. I mean, you should have your sound money bucket of assets. I mean, you should probably have some real estate assets and some cash assets, and maybe some common stock assets. Although I think in general right now, most common stocks are pretty overpriced. But, you want to have a portfolio that reflects a lot of different things. So, no matter, I mean, the future is always uncertain, right? And so, risk diversification, suggests that you try to have a bunch of things. And, I think everybody has to make their own choice of how much. I mean, I think if we continue to have monetary debasement, and I believe with a high probability that we will, Bitcoin will go higher and gold will go higher. Bitcoin will probably go higher in a faster way, but also in a more volatile way. And so I would suggest that, you can kind of look at these maybe the way people used to look at stocks and bonds, where, gold is more like the bond and Bitcoin is more like the stocks.
Great point.
Now, before we run out of time, I want to throw up a good chart that you retweeted yesterday. It's looking at Fed funds rate and then also kind of what's priced in as far as the market's expectations. So it shows that investors are very sure the Fed will have to cut rates over the next 18 months. Are you not as sure?
No, I'm pretty sure they will as well. None of us know the timing, but that's what the forward futures curves are showing. It's what the Eurodollar curve is showing. It's what the market is sniffing out. It's what, the gold and silver are starting to sniff out. The charts are looking pretty strong right now. And it tracks with what we see going on in the economy, which is what, Mohamed El-Erian said it. He said, the Fed slammed on the brakes and the economy is in the process of going through the windshield. And,
Right.
when the economy goes fully through the windshield and things really start to break, even if inflation's 5%, they're not going to be worried about inflation anymore. They're going to be worried about saving the economy. Yeah. And so my sense is at that point in time, they will be forced into pivoting again. And there are a lot of other reasons that that's the case as well. I mean, they're running much larger than expected deficits. And that's the result of the higher interest rate costs on the debt. And there are a lot of things going on that are going to drive them to have to start printing again. I mean, Max Kaiser said it so well. I mean, you can't taper a Ponzi scheme, and a fiat currency system based on continual money growth and credit growth. Yeah. You can stop the money growth, you can stop the credit growth, you can do what Volcker did and jam the rates up high enough to create positive real yields and a lack of growth in the money supply. But guess what? In a highly indebted system, it'll collapse. And so. That's
And
what's
Larry,
happening.
that's the fundamental difference. Like it just the fact that everyone's, well, we're going to do a Volcker. Well, the difference is how much debt we've accumulated since Volcker.
Exactly. I mean, we're at 130% debt to GDP. When Volcker did it, was 30.
Yeah.
And there's debt everywhere. There's leverage absolutely everywhere. And liquidity, there's going to be a real premium. I mean, if we are in kind of a deflationary period right now, not severe yet, but going there. And you're seeing it. You're seeing signs of it. I mean, look at Blackstone gating their real estate fund, and then, Starwood following with suit and gating their real estate fund. I mean, that's basically, they're just saying, hey, we can't meet all your liquidity needs. And so, you can't pull your money out of here.
Yeah, Larry,
right?
like how big of a deal that is that? Like to me, that just feels like this is one of the largest real estate funds, and they're just saying, wait a minute. You know what I mean?
Well, what they would say is, hey, we told you that when you invested. But
Yeah.
what I don't think people have realized, I mean, it's like so many things. It's like FTX, right? Because you're comfortable having your money there until you're not. And there's nothing scarier than you have your money someplace and you go and you say, hey, I want my money back. And they kind of say, well, sorry, we can't give it to you. And then you really start to get scared, right? Holy shit, is this money good? And have I been rugged here? And, that we're seeing that pattern, more and more in different places. And, it's not a good pattern. It makes everybody, it's the reason why people in the gold space and the people in the Bitcoin space say, not your keys, not your coin, or not your gold, not in your possession, not really your gold. I mean, there's a lot of paper gold out there, right?
Yep.
So.
And Larry, just that Bitcoin Africa, I don't know if you follow. I found that so profound. Like that to me, if you talk about not trusting central banks, let's go to emerging markets with like you got entire populations that could really just step off these absolute banana currencies, right?
Yeah, Alex Gladstein wrote a book called Check Your Financial Privilege, which is a fabulous book. I encourage everybody to read it because it's so hopeful for the future, and it talks about an important issue here. It has a lot more to do with the number go up, right? I mean, people in emerging economies all over the world have been screwed for 50 years by their local currency boards and so forth, and they're continually inflated away, debased. Their money is seized, whatever it might be, like in Cyprus, and Bitcoin represents money that governments can't mess with, and it's a lifesaver for people, and it's why the use cases in some of these third world countries, and that's why El Salvador adopted it. I mean, the use cases are absolutely compelling, and it's changing lives. It's making the world a literally better place. The fact that these people can now save in a currency, even though it's volatile, they can save in a currency that will not be depreciated by the government. And over time, it will grow in value because there's a fixed supply. It's therefore a deflationary currency. I mean, we've got 8 billion people and 21 million Bitcoin. I mean, being a whole coiner someday that'll really matter. I mean, 8 billion people, 21 million coins, right?
Well, Larry, like just on that point, and just on the fact that this could be like Bitcoin as a transactional currency, right? And this is something gold, obviously, at the time of
that's long gone for gold.
But it's not. It can't. Like it's never going to do it as well right now. I just wonder. This really is gold 2.0, right? In the sense that
absolutely. No, Bitcoin is clearly
you're getting
Bitcoin
the transactional aspect of it.
Yeah, Bitcoin is clearly digital gold, and Bitcoin will ultimately flip gold, but it's not going to happen overnight. I get very tired of all the Bitcoin people saying gold's a piece of shit, and all the gold people saying Bitcoin's a piece of shit. I mean, they both exist. They both have a role. They're different. There's I mean, before 2008, gold was your only choice. I mean, thankfully, you now have the Bitcoin choice. The rails are getting built. I mean, most of your listeners are probably familiar with the Lightning Network. I mean, the Lightning Network is going to change the world. I mean, you download a Mun wallet, and I can send you any amount of dollars instantaneously for less than a fifth of a penny. I mean, it's really pretty stunning. And, think about remittances. Just, the people who have relatives working in the U.S. and they're sending something home, to them to help support them. I mean, they used to get ripped off by Western Union and the bodega owner and along the way, they might make a few $100 and they might see 70% of what they made because of all the fees they paid and getting it from, the U.S. to where they are. Now they can send it out of one wallet for less than a penny, a transaction. It's kind of stunning. And these kinds of use cases, they're just going to continue to grow adoption everywhere. And as more and more people use it, I go back to the basic math: 8 billion people, 21 million coins. Do the math, right? I mean, this is not hard. I mean, people ask me, they say, what would make you be concerned about Bitcoin? Worried about your Bitcoin investment? And I'd say, I would be concerned if the use cases disappeared, people lost interest, and less people were using it. But what I see is the exact opposite of that. Use cases are growing, usage is growing, addresses are growing, adoption is growing, and there's a fixed supply of these coins and 8 billion people. I mean, in Nigeria, I'm told that, 20% of the people are using Bitcoin and Lightning for their financial transactions. I'm not sure that's accurate, but, there are a couple 100 million people in Nigeria. I mean, it's kind of like the way when the cell phone came out, a lot of countries didn't even put in landlines because the cell phone just kind of, you skipped it. You've got these countries that are kind of where all the people are unbanked. I mean, all you need is a smartphone and you can have a Bitcoin wallet. And so, you're actually starting to see, people who never had a bank account, they might have Bitcoin on their phone. And, they might, if they've got vendors in their area that will accept Lightning payments, well, guess what? They're doing payments and they're making transactions. They're doing monetary transactions without a bank, a credit card company, or the government being involved. That's a very powerful thing.
Lawrence, this is a very hopeful tone that we've ended off. So I think this has been a great conversation.
Well, Lawrence, we got to have you I'm trying to bridge the worlds of hard money. We're going to do I was going to do a gold conference. Like, you know what? We got to do a hard money conference. You know what I mean? Bring the worlds
right.
of Bitcoin.
It's not about gold or Bitcoin.
Yeah,
it's sound money. Sound money. I mean, it's, we got analog sound money. We got digital sound money. We're all on the same team.
I love it. All right, well, Lawrence Lepard, Equity Management Associates, thanks so much for being with
us. Thanks, guys. Good to be with you. Take care.
Thank you.
All right, everyone. The packed schedule keeps on going, baby. All right, so next up, we got Greg Foss. He's executive and shareholder of Validus Power. So we'll be back in just a minute.
Hi, everyone, and thank you. We are pleased to introduce Greg Ross, who, as everyone knows, is the executive and shareholder of Validus Power. He's also a veteran Bitcoin bull and has a long history as a risk asset manager. And I just want to kind of start off the first question a bit macro, just given everything that's going on. How much does global monetary policy have to change to accommodate BTC? And do you think BTC is the only coin we can say has a true store of value, given everything that's going on right now?
Oh, that's a big question. Let's start with global monetary policy. I'm a mathematician. Well, I'm an engineer, so I like math. I wish I was a mathematician, but I'm not that smart. But I always try to focus on mathematics. We are in a global debt spiral. Okay, very simply, the size of our total global debt balloon is 400 trillion US dollars, and the global economy is only 100 trillion US dollars. And there is no way to mathematically escape the certainty that the interest payments on the debt will exceed the growth rate on the economy. So in other words, the numerator is going to continue to expand faster than the denominator. The error term in that, to solve the debt spiral, is printing more money. 100% certain. Now, Larry Lepard, who was just on, said he's highly confident that monetary policy will continue to expand. I'm going to go further and say I'm 100% certain that monetary policy will continue to expand because it's only mathematics, okay? So there's very few things that are certain in finance, but fiat debasement is 100% certain. We have reached the point of no return with respect to a debt spiral. So to answer your question, Bitcoin solves the debt spiral. Very simply. Why? Because it's got fixed supply. No other digital asset has that characteristic. You can ask Vitalik what he says the supply of Ethereum is, and he'll say something like, well, it's uncertain. As a mathematician, I don't like uncertainty. I like to know what my fixed supply is. So in my opinion, Bitcoin is the only digital asset that solves the fiat debt spiral. Now, this is a global phenomenon, but every single country exhibits it. Canada is leading the race, unfortunately, just due to our reaction, our response to the COVID crisis on a total debt to GDP. But the USA running, as Larry Lepard said, 130% total debt to GDP, government debt only, doesn't include corporate, state, or other structured product debt. So, in my opinion, there is no concern about the monetary aspect. That is written in stone. What you need to do is protect yourself against that certainty with hard assets. And I'm in Larry Lepard's camp. I own other hard assets besides Bitcoin. Yep. However, I think Bitcoin is the best horse in the race. It's the most certain from a supply standpoint. Larry likes gold. I like gold, but I like Bitcoin better. And here's something I'm not sure that came up in your conversations heretofore, but if the price of gold were to double tomorrow, do you think the supply of gold would increase partially above its 2% annualized growth rate? There's no question, right?
I know I would be going to the those jeweler what do you call it, the
pawn shops, the pawn shops. Yeah. But if the price of Bitcoin were to double tomorrow, the supply of Bitcoin is fixed. Okay, there is no uncertainty in the supply. Bitcoin is the most beautiful technological innovation that I have ever seen, and it is the best asymmetric upside opportunity I have ever seen as far as managing risk goes. So I like to think of Bitcoin. Larry said digital gold. I'll take it a step further. Bitcoin's actually digital energy. And that's where things get really exciting. And how Bitcoin can help solve some of the energy, I'll call them conundrums we have with our grid, for example, our electricity grid. And how Bitcoin can Yes.
Yeah, I'm very curious about this because I covered utilities as an analyst for a long time, and that's the part that I'm the most skeptical around. Just from I just think of Bitcoin, while all of the positive characteristics, I still think that there's this net draw of energy. I'd love to hear you talk through how it can help, right, from a power perspective, because I just see it as a net draw, which I think is worth it. Like just like gold, you're expending energy, for a hard money that there are things you're gonna have to live with. But I struggle with just some of the more nuanced arguments around that, how it sits as something positive.
Okay, so let's start with how the grid is constructed and the ancient technology of our electricity grid globally. But remember that a grid has a base load that is designed to accommodate 6 p.m. power draws in your neighborhood. Why 6 p.m.? Well, people get home from work, they turn on their air conditioning, they turn on their stoves, they turn on their heat perhaps. But the point is, this base load is designed for a peak draw in power, typically in the evening, but that draw in power is cyclical. That doesn't mean you power up and down your nuclear generators. It doesn't mean you power up and down or you stop the rotation of your hydro dams. The power is being generated, and if there's not a draw on that power, the grid becomes unstable in the other direction. So the grid can become unstable because there's too much power being drawn, or the grid can be unstable because you have supply and nobody drawing the power. And you can't power up and down your nuclear reactors. You don't turn on and off your solar generators and your wind generators. They turn. If you don't have a draw of that power, either selling it to the United States, or in some cases, did you know in Canada's case, we pay the Americans to take our power? At times of day, Canada pays America to take our power. Why? Because it's got to go somewhere, or else transmission lines will blow up. So what's smarter that we had Bitcoin mining capacity drawing as the last marginal user of power, and when the grid needs more power, you flip the switch off, because Bitcoin mining can be powered up and down in a second. It's like a stabilizer in the grid, okay? And here's another thing for you. If you're designing a 20-year nuclear generator, because that's how long it takes a payoff, a return on investment over a 20-year period, that CapEx can be, or return on investment can be reduced meaningfully when you include Bitcoin mining revenues in that projection, because the nuclear reactor has to run all the time. But if you don't have the demand, you're giving it to the United States. Or if you have Bitcoin mining demand and creating revenue from the Bitcoin, holy smokes. So let's take it one step further. You guys talked about Africa earlier.
Can I just visualize that just a little bit? The way you're thinking about it is there's base load, and you may not be using all that base load, when the power, when usage is lower, and you're just basically skimming off what would normally go to some other jurisdiction. Is that right?
Or damage your system. So you're actually protecting the system as well. Now, in the case of Africa, because I wanted to mention that, they're actually creating electricity for villages because they get Bitcoin mining turning on rivers, okay, that provide electricity to the village, but are able to create a revenue stream that makes a capital expenditure worthwhile to power villages in Africa. Look at a recent investment by Twitter founder Jack, drawing a blank on Jack's last name, but Twitter guy, and Elise Killeen. I think it's called Gridless. Okay, this is an issue for Gridless, powering Africa using very small size Bitcoin mining and Bitcoin power generator that's providing utility and energy to the citizens of Africa.
And I just wanted to follow up on that. If you have a perspective, which developed nations, if any, do you think will be the first to incorporate BTC on their balance sheet or BTC in a big way into their economy?
Russia. If you can include Russia as a developing nation, why? Because Putin's smart enough to realize he doesn't want to get paid in US dollars for his valuable natural resource energy. He's already negotiating getting paid in yuan and potentially gold and eventually Bitcoin. Why? Well, there's no payment freezes on Bitcoin. It's much easier to transport than gold. It's not US dollars. It is digital energy. So why sell natural resource energy for depreciating US dollars when you can sell it for very valuable digital energy, Bitcoin? It may not be the first one, but it'll be the most substantial one. We already have, I know it's an emerging nation, but El Salvador, I was down there a month ago. Lots of exciting things happening in El Salvador. Point being, it is a process. And this process doesn't happen overnight. Another thing that Larry Lepard said, we got to examine 20-year time frames. And that's why I'm so bullish on Bitcoin. Very simply, you don't have to have 100 cents of every dollar in Bitcoin, but please don't have zero. Okay, it's more risky to own zero Bitcoin than it is to have a proper portfolio allocation. And I'll say to people, start at a 3 to 5% portfolio allocation in Bitcoin, and focus on the other 97 to 95% of your portfolio in the short term. And think of Bitcoin as your insurance on the fiat Ponzi, very simply, okay? Now, I got involved in Bitcoin in 2016. The price was obviously lower, but this is what I want to stress. Bitcoin today is actually a better risk-adjusted investment than when I got involved in Bitcoin in 2016, okay? Very simply, why? My screen just froze. Okay, good. Very simply, why? Because of the certainty of the debt spiral, the certainty, the way the governments reacted to the COVID crisis is now impossible to escape the debt spiral, okay? Before we had a fighting chance, now it is not possible mathematically to escape that spiral. You need certainty of a store of value. In my opinion, you need to own some Bitcoin, very simply.
Greg, just maybe just on that, the fact that, when you believe the risk reward is better now versus when you first got in. The other aspect here is too, like maybe this cleansing of the system post FTX, post SBF, that, all these shit coins dying, that money kind of flows into Bitcoin.
Yes, sir. But, let's not worry about the other shit coins. There's a lot of shit coins in the world that aren't digital assets. Okay. I mean, tons of penny stocks are shit coins. I was on stage at Bitcoin Miami, and a couple of billionaires did refer to the US dollar as a shit coin. I'm not quite rich enough to refer to the US dollar as a shit coin because the Canadian dollar, if the US dollar is a shit coin, I don't even want to describe what the Canadian dollar is, okay? But let's just be careful and understand that it's Bitcoin is an IQ test in risk management. It's that simple. And if you have the best asymmetric return opportunity that I've ever seen in 35 years of managing risk, I'll just tell you, you need to have a certain amount of exposure to that opportunity. I believe Larry Lepard mentioned a price target of Bitcoin of $1 million. I'm not going to argue with that. And in fact, Fidelity has the same price target. I have a price target slightly higher. And the reason I have it higher is because I use a debt calculation. I use debt metrics to calculate an outcome for Bitcoin. Now, all of this is to say you got to have a target and you can have a time frame, but never set both on TV. So my price target for Bitcoin is $2 million US per Bitcoin, but I'm not going to give you a time frame. I'll just say over my lifetime, the price is going higher. But the price target is based in today's dollars. So $2 million per Bitcoin is my price target, and the market is trading today at under 20,000. That tells me as a risk manager, the market is giving me a 1% chance of being right. And I'll tell you, I'm not 100% certain of my price target, but guys, I'm way more confident than 1%. Okay, it's that simple. Right. Do the math, do portfolio analysis. How do I get to 1%? Again, 20,000. Divide by 2 million is 1%. Well, it's trading at less than 20,000, so it means it's giving me a less than a 1% chance of getting there in today's dollars. So don't overthink things. Own some Bitcoin, put it away.
I think we got Greg frozen up there. Oh, Greg, you're back. I hope.
Oh, you're back. Are you back?
I hope. Greg, you there? You're in slow-mo.
Oh, I think we lost Greg.
You know what, man? You know what? The Bitcoin energy, that core of Bitcoin energy, Margot.
That was great.
Yeah, that was.
I'm back, but hold on.
Oh!
The screen froze. It was freezing when Larry Lepard. I know what my time is up. Just
my
more
time's
than
not up.
zero.
Listen,
You were walking us through the math of of your portfolio strategy and Bitcoin.
Yeah, so 1% chance. Well, look, if I'm right, you're going to be very upset you didn't own Bitcoin, and if I'm wrong, well, you can probably live with a 2 to 3% allocation in your portfolio. I don't think it goes to zero, but even if it does, the expected value outcome is just so in favor of owning Bitcoin. So again, as a risk manager, you always look at things in portfolio in terms of probabilities. Please do that and focus on the rest of your portfolio that's at very severe risk of being debased. Don't focus on the Bitcoin allocation.
And so, Greg, I should know this, but maybe you can help. You're closer to this. So, what if in the classic Fidelity asset allocation wheel with like freaking 100 different flavors of the same schlop of equities, you go from 0 in Bitcoin and now you got a 2%. What should that theoretically take Bitcoin to? Like, if they were like, listen, we're gonna do that for our asset allocation.
Great question. So how about this? Total global financial assets today are $900 trillion US.
Okay.
Right. 900 trillion. So what's 2% of 900 trillion? That's 18 trillion. What's 18 trillion divided by 21 million? It's almost $1 million. It's almost $1 million. It's almost $1 million of Bitcoin. That's why, if the world went to a 2% allocation based on today's global financial assets.
Oh no! Greg's frozen up. Greg, we're gonna wait for Greg because we gotta let him finish the point. We're having in and out, but that was
I really like how he breaks it down for everyone.
Yeah, so the numbers anyway, I'm gonna slaughter the numbers here, but the bottom line is you got this big pie of global money trillions, and you take. Hey, Greg,
I'm so sorry. It's my fault. The internet is weak at this end, but look, yes, take the global pie. That's how I get to 2 million of Bitcoin, by the way. I think Bitcoin takes a 5% market share of 900 trillion, which is 45 trillion. 45 trillion divided by 21 million is over 2 million.
That's the math, folks. Greg Foss, man. Epic.
Thank you so much for coming.
Epic. Hey, listen, you're going to join our hard money, sound money, friendly money conference. Greg.
Yes.
Hey, listen, guys, just give us 2 secs. We're going to be back. Scott's going to come back. We're going to talk a bit about what we're doing. Give us a minute here. That was Greg Foss, a phenomenal
executive and shareholder of Validus Power.
Exactly. Yeah, give us a sec. We'll bring it. We'll rewind it back.
Whoa,
man, that was good. Let's go. Listen, thank you everyone for watching. That literally, that was some serious insights. A great, from start to end. That is phenomenal. And so we just want to let everyone know, if you don't know, we just started our Substack, grizzleresearch.substack.com. We started with oil. We're hard asset kind of firm here over here. So we're always analyzing commodities. We also look deeply into the world of growth stocks, and we're crypto curious. But we do believe in Bitcoin and hard money and gold. And so all of those things. Scott, you want to tell a little bit more about what we're doing on that side?
Yeah, we're excited about the Substack because it's a little bit different than, there's a lot of good content on Substack that other people are doing. We're doing it a little bit different. We're using the power of quantitative analysis to kind of supercharge everything we're doing. So you're going to get ideas on stocks. That's what you know us for, stock picks. We're going to put together portfolios, quant-driven portfolios, kind of like our best ideas in all different sectors. We talk about markets overall, helping you navigate what's going on. So it's going to be a little bit of everything, but hopefully you're going to find it really impactful and you're going to come away with a lot of ideas and education on how to set up your portfolio and how to manage risk. We used to do it professionally, managing risk, and so we're going to give you a little bit of tips that we've used.
Yeah, and the goal is like, we feel that, hey, listen, there's always lots of ideas. Great, Twitter's great, man. It's revolutionized the world. Substack is great too. People are bringing together their ideas, and then finally, it's the thing that's missing here is just how do you put it all together in a portfolio context? How do you at the end of the day, you're going to the casino, right? You're not, and I think, having Greg leave it off was probably the best. Like, Bitcoin is obviously a big thing, but him coming to the 2 to 3% position allocation is a function of the upside that he perceives. That, listen, worst case, it's a nothing burger, but that's not a big deal. Base case, this thing goes up a lot, and best case, it's a $2 million asset. So, it's
just not all or nothing, which is nice, right? He's thinking of it in a portfolio. It's not, do I put all my money in Bitcoin or do I have nothing in Bitcoin? There's an in between.
Exactly. And guys, we hosted a great, so follow Scott Margo _Rubin, Scott W _Grizzle, myself, and obviously the Grizzle main account. You'll find everything that you're watching this through. We did a fantastic Twitter Spaces on Friday. We do a market wrap Spaces. We're going to run that again on Friday. It was a great conversation, and the goal is just really kind of take away a lot of the BS, for lack of a better term, BS, noise that people are just so focused on the here and now. We just try to really pan back and say, listen, what's the opportunity? Our latest piece in the Substack is on energy, and there's this dichotomy right now between oil, crude oil, and oil stocks. And we talked through some strategies on how to play that. Today I highlighted, and we haven't looked at the board again, but literally crude was up 3%, Scott. So typically when you have a super rally day like this, the way it works is that oil, crude oil will go up, say, 2%, and then oil producers will go up 4%. Why? Scott, explain why an oil producer should go up more. But I'll caveat that today oil went up 3% and the producers were up 2%, which if you go to the Substack, we explain exactly why that went down.
That's important. Basically, with producers, they have fixed costs, right? So if the price of oil doubles, their costs don't double. So that's why there's torque in owning the producer. That's why it should mathematically go up more. Earnings should go up more for a producer. Then, oil goes up 1%. Earnings should be up more than 1%. That's why the stock moves more.
Yeah, guys. We're gonna walk through that. Scott's a machine, man. The professor, and he ran through we're looking at options. We're looking at, anyways. We'll get into details later, but we got a great.
Where do they find the Substack?
Grizzleresearch.substack.com.
Or in our bios on Twitter, you can find the links there.
Exactly. If anyone, listen, guys, let us know what other conferences. This was we wanted to do a based crypto conference, and this was based. This was truly we got some dudes who were truly the Ben Hunt was just I'm like, oh man, I just was I was hit with, it true to me. That was one of the best.
He was bringing some empathy to crypto, he felt bad for people,
but you know what? It was not even bad. It was so much of it is oh shit.
Yeah, he was animosity directed towards the charlatans and the fraudsters.
Exactly, because so much of the other side, if you're not involved in crypto, the other side of crypto is oh, you guys are dumb, this, that, the other. But he brought it to a level of it is a level of entrepreneurialism. There is great energy and there's a lot of great people involved. But the other part about it is that you got this whole field of charlatans and hucksters, right? And that is a challenge. And obviously, we take the positive view, cup half full. That listen, Bitcoin is a powerful asset. We're in a world. If you listen to Greg Foss, Larry, those guys, laid out a real clear case for this. And couple that with Ben and Doomberg, as always, man, always dropping great hits. And Steph Ouellette that was an interesting take from somebody who managed risk really well. And that's, to come to, doing what Steph does in the space of institutional crypto and coming away unharmed out of all of this, it really tells you you got to know who your counterpart is. You always got to know who your counterpart is. Yeah.
Well, so I think that wraps up Grizzle Crypto from the ashes. Hopefully you understand kind of what the future holds, where the risks are. Remember, spaces, 12:30? 12. We're going to do 12. Noon on Friday. Every Friday at noon, we're doing a spaces. So pop on in. It was a great time last time. Lots of knowledge being dropped, lots of fun being had.
Yeah, guys, thank you so much. Thank you for tuning in, and share this, retweet if the people need it. We'll be tweeting out the segments, and it'll also be available on podcasts. You'll see all of that. Thank you very much, everyone, for joining.
Thanks, everyone. Grizzle out.